Hi, I'm James Robinson, and this is my stock pick of the week. This is part 2 in my 5-part series on the company Expeditors International of Washington. Today we're going to look at the company's operations. What we're looking at is how efficiently this company delivers goods and services to the clients. So the first thing I always look at when I'm looking at a company are the company's gross margins, and it's a big determinant for me if I'm going to invest in a company. I like companies with very high gross margins. I like it so much that I actually did a video on the importance of gross margins, and I'll leave a link to that video down below in the comments. Having said that, this is an example of how you can't just simply have a litmus test and ignore everything about a company. When you look at this company's gross margins, they're very, very, very low. In fact, they're in the bottom 10% of companies. And so if I think that gross margins are so important, why am I suggesting you should invest in this company? Well, the first thing you have to do is understand what's happening with what gross margins is. Gross margins is the result. If you take the company's revenues, you subtract the cost of goods sold, you're left with the gross income, and the difference between revenue and gross income is the gross margin. So you want that number to be as high as possible. You want the operating profit, the gross profit, to be as high in relation to the revenues as possible. But with this company, what they do is they operate very much like brokers. They are finding shipping solutions to their clients, and they're actually charging the clients and then paying the shipper. And so there's a certain amount of the income that's coming in that is just a transfer fee. It's not really representative of their cost. It's really just representative of the cost they're providing. So to put it in a different perspective, my primary job before I started managing money was as a commercial real estate agent. And my commission was typically 5% of the value of the deal. Now, when I negotiated a lease, the tenant paid the money directly to the landlord, and they paid me a 5% commission. If instead of doing that, they had taken 100% of the rent and paid it to me, and I'd paid 95% of the rent to the landlord, well, then my margins would be very, very small, even though the income stream is exactly the same. And that's what's happening here. So these gross margins are artificially low, and you have to take some time to understand that. And that's why there's no one-size-fits-all to investing. You want to take a company and you want to understand what's going on with it. You want to do more than just look at these charts. You want to read the annual reports and understand the business and do a lot more homework than that. And when you can do that, you start to see through these things that would otherwise turn you off as to a company. So the truth is, when I looked at the gross margins for Expeditors, which is the first slide I looked at, I was almost instantly very disinterested in the company. But the next slide that I looked at is this, which is earnings and earnings per share. And you can see that this company's done spectacular on this over the last 20 years, with virtually every year being an up year and no 2-year losses in a row over that time frame. And so I said, well, wait a minute. This company's making more and more money every year. The earnings per share have gone up, 400% or something over the period of time that we've been from 2002 till now. I got to understand what's going on here. And it was because I look at multiple slides, and I didn't just look at one slide, that I was able to go back and really get an understanding of what was happening with gross margins. So again, what you see here is that, the earnings per share have gone from, call it 75 million in 2001 to 700 million in 2021. That's an increase of, whatever it is, 6%, 10 times or something. And then it looks like it's gone from 25 cents a share to $4 a share, which is also an increase of 10 times over the course of 20 years. Those are spectacular earnings numbers, and we really want to be buying companies that can do that if we can. Especially if, like we can right now, we're able to buy that company at 10 times earnings. Net earnings as a percentage of revenue. Again, this slide is going to suffer from the same thing as the gross margins analysis. Because such a huge percentage of revenues are just transfer fees, I've really just chosen to ignore this. I know that it's in the bottom of 25% of companies or 20% of companies, but at the bottom 50% of companies, but I just don't care because I understand where some of that money is going. The same thing is true with revenues as a percentage of net earnings. You can see the net earnings are very, very small, but they've gone up every year, but not nearly as fast as net revenues. Normally that would scare me about a company, but not in this case. So now we get to what I call the 4 taxes. These are things that every company has some of these costs to some degree, and they're sort of costs of owning a business. You don't pay them to the government, but you pay them for operations. And the extent to which you pay these can often result in the desirability of the company. If we have really gross margins, but these numbers are really high that we're going to talk about next, it can destroy what would otherwise be a good company. So those 4 things are selling and general administrative expenses, plants and equipment, research and development, and inventory. And if a company has too much of any of these, it can really hurt the fundamentals of the business. And so I look at these things, try and just get a sense of the fundamentals of this business are solid. So in this slide, we're looking at the selling and general administrative and plants and equipment. You can see here that from 2004 to 2010, the selling and general administrative were through the roof. I actually didn't go back and look at why that was. I don't know if there was an accounting change. Maybe they called something selling and general administrative that wasn't, or if they had a new CEO that did something. It was 12 years ago, far enough in the past that I didn't go back and look at it. Since 2011, this number has been low and frankly getting lower. It's in the top 10% of companies for selling and general administrative. That's fantastic. That's almost all I need to see. I love this company selling general administrative. Plants and equipment, it's in the middle of the road. This is plant and equipment in terms of assets. So again, I don't love this, but you could see where it's not big enough that it's going to matter in terms of destroying my business. It's also been very, very flat. And that tells me that it's under control and the business knows what they're doing. And despite these plants and equipment being at the rate they are, the profits have gone up virtually every year for the last 20 years. So we kind of overlook plants and equipment. It's not super high, it's kind of middle of the road. One of the things that I love about this company are that the inventory is zero and so is the R&D. And let me talk a little bit about inventory and why it's important. There are a number of things that are happening with inventory that you can tell by looking at inventory. The first thing is you have a significant investment in inventory. It's money that you've paid to produce a product and you haven't sold it yet. And so the more money you have there, that's more money that your company has to be tied up, that it can't be using profitably or can't be returning back to the shareholders. Additionally, in many industries, inventory goes stale and goes bad. Obviously, if you're selling fruit, you understand the apples go bad in the inventory and you just don't have apples anymore. But if you're selling high-tech equipment, if you're still trying to sell an iPhone 5, that's worthless, right? Even an iPhone 10 is worthless. So inventory over time tends to degrade in value in almost any kind of inventory. So the more inventory you have, the more likelihood that inventory is degrading in value and you're losing that money. So when you see a company with no inventory, that's obviously a plus, that you don't have any of that risk. The next thing is R&D. R&D is a big thing, and in this company, its cost is zero. Again, R&D is different from inventory, but it's a cost of maintaining your business. Generally, if a company is spending a lot of money in R&D, they're doing that because they're selling something that's new, that's never been done before. And the problem with that is that your R&D, you tend to get diminishing returns in R&D. When you make your first new product, that takes off, and if you're a successful company, that's fantastic. Your RIM, and you make your first BlackBerry, that R&D money is very well spent. But that company probably continued to spend money on R&D. They never came up with the next new product. That's what makes Apple so spectacular, is Apple continues to spend a fantastic amount of R&D, but they keep coming up with these new products that captivate us and make us want to buy more. But again, the problem is that R&D money is money that's gone, and there's no guarantee it's going to result in anything. You might spend a bunch of money in R&D and not have a product come out of it, and the money is just burned. So if you can have a company that can make profit and grow its profits every year without R&D, that's exciting to me because it reduces one of my risks for places that my money could go that I'd rather it not go. The final tax that I talk about is interest payments. And interest payments are the most nefarious because oftentimes the time you need to cut interest rates are the times that you can't. You have to pay the bank every quarter, whether you have the money or not. And if you don't, oftentimes they can take your assets away from you or force your company into bankruptcy. So when there's no interest expense, I like that. Additionally, companies that have no interest expense, thereby having no debt, that's a good sign that this company either doesn't need a lot of cash to operate, which I really like in a company, or is extremely profitable to the point that they're able to fund their own growth, which I also really like in a company. So just the fact that I'm paying interest expense is a bummer, but the fact that I don't have to pay interest expense demonstrates to me that this company is doing so many things right that they don't need debt to continue to grow their business or to maintain it. And that's something that's really exciting. And since 2014, EXPD has had no debt and thus no interest payments. So that's a really fantastic sign for this company and its operations. So let's go back and look at the operation of this company in summary. We talked about the fact that the gross margins are extraordinarily low, but that there's a reason for that. And it doesn't really mitigate my interest in the company, especially when I looked at the other points that we're going to talk about in a second. The company's profits have grown up basically every year for the last 20 years, and they've gone up 10 times in that period of time. That's very, very exciting, especially the consistency with which they've gone up, especially when I'm buying the company at 10 times earnings. The income as a percentage of revenue is small. We've touched for the same reason that the gross margins are small, so we're not worrying about that. Selling and general administrative. Now, let's talk about the 4 taxes. One of the things that's great about this company is that the 4 taxes are effectively all very, very strong, well, except for plants and equipment. And because of that, that means this company, once it gets money to the bottom line, a huge percentage of that money comes back to us, the investor. So general administrative companies, it's basically always been in the top 10%, or at least has for the last 12 years, top 10% of companies. Plants and equipment are very average, but R&D is 0, inventory is 0, interest payments are 0. And when you add all that together, you have a company that appears to be extremely well run, that doesn't need a lot of capital to run, that generates enough profits to pay its own, to fund its own operations. They don't spend money in R&D, they don't have any inventory, and they pay no interest. I mean, what else can you want in a company? This is really, really great stuff. And these are the reasons, kinds of reasons why you should want to buy this company. So thank you very much for your time, and new videos coming in the next few days.